Let's face it, trading can be tough, especially when it feels like the market is working against you. But what if I told you there is a simple tool you can use to turn the odds in your favor? In this video, I will show you how I overcame my own trading struggles using moving averages, so stick around to learn how you can use them too to improve your own trading results. The biggest challenge I faced as a trader is that I found myself constantly struggling to find the trends and make profitable trades. I would easily get caught up in emotions of the market, and I often found myself entering or exiting trades too soon or too late. And I remember feeling helpless as I watched my trading account balance shrink day after day, especially when I was trying so hard for months to profit, but no matter what I did, I just couldn't seem to get it right. As if the market was mocking me, daring me to try harder. And on top of feeling helpless, I felt like a complete failure, like I wasted so much time and money on something that wasn't meant for me. But then, as fate would have it, I stumbled upon an article about moving averages. I had heard of them before, but I never really understood how they work. So I started doing my homework and trying them on my demo account. And to my surprise, things started to click. The market wasn't so unpredictable anymore, and I was able to identify trends and make trades with more confidence than I ever before. And as I continued to explore the moving average strategy, I discovered that in order to use moving averages effectively, I had to determine the appropriate time frame to analyze. I learned that typically the longer the time frame, the stronger the trend, but delayed signals. And therefore, I found that it's crucial to combine multiple time frames to get a clearer picture of the market movements. When it comes to technical analysis, I always perform top-down analysis, starting from the monthly down to the 4-hour time frame. Let me show you an example of a trade I took on March 6th, which was a buy position on the Euro-CAD currency pair. On the monthly chart, I noticed that the price was in an uptrend, which was confirmed by the 20-period moving average being broken, and the price was around 220 pips away from being retested, as it has happened before if we take a look back over here. So I then looked at the weekly time frame and noticed that even here the moving averages are trending below, confirming the bullish bias, and the price has made a new high because it has clearly closed above the previous high. So on the daily, I had very similar scenario. The 20 and 50 moving averages are below. However, we also have a daily resistance because of multiple rejections in the past, signaling me that even if the price goes up, it more than likely will react to this level. But I was thinking that even before the price does that, we have at least a 60 pip zone that we could profit from. So I moved on to the 4-hour time frame, and here's where all the fun begins. And the reason I'm using 4-hour chart is to determine the best entry point. So based on this analysis, I discovered that the 20 and 50 period moving averages were acting as a dynamic support. And as someone who likes to play safe, I usually wait for the 4-hour candlestick to close before making a trade. But please remember that you cannot only base your trading decisions on the closure of a candlestick, and price action and fundamental analysis is also a part of this big puzzle. And as I mentioned before about bullish engulfing candlestick closing above one of the moving averages, it's usually a successful trade, so I can show you a few examples. So let's say you would enter on this bullish engulfing candlestick bouncing off the 20 period moving average. And of course, based on your risk management and target levels, you could potentially profited 40 pips, 80 pips, or even around 110. Or maybe you would be entering on this huge bullish engulfing candlestick that just crossed above the 50 moving average, and I usually go for 80 pips, but again, that depends on your risk management and your risk tolerance. Or if you let the trade run, you could potentially profited around 180 pips. So this was just a couple examples on how you could potentially profited based on a bullish engulfing candlestick closure. Now that I had a clear direction for the market and a plan for my entry, it was time to focus on risk management, which is absolutely critical for any trading strategy. So in this case of the Euro-CAD trade, my stop loss was strategically placed below the 20 moving average. So the trade played out as analyzed, and as you can probably see here, the 20 period moving average has again showed its benefits by reacting as a support, and the Euro-CAD pair eventually hit my last profit target, which was 160 pips. But you know, sometimes trading is not all about rainbows and sunshines, and as a trader, traders, we will inevitably experience losses, but it's how we deal with them that truly defines us. I have certainly had my fair share of losses, and I know just how difficult it can be to pick yourself back up after a significant loss. One particular trade that comes to mind is a trade I took on NZD JPY pair back in February. The weekly and the daily time frames was trending down, and I thought I had identified a great entry point. I had my moving averages lined up, covering my stop loss, so I entered the trade with a lot of confidence. However, as soon as I entered the trade, things started to go wrong. The market didn't behave as I expected to, and I was down a significant amount of money. And eventually the trade hit my stop loss. Looking back, I realized that I made a common mistake that many traders make, not following my trading plan. I knew that my trading plan called for me to wait for some sort of bearish candlestick closure before entering the trade, but I let my emotions to get the best out of me, and I entered the trade prematurely. To avoid making the same mistake in the future, I recommend myself and you guys to stick to your plan no matter what. And I always say that backtesting is a crucial step in developing and refining a successful trading strategy, because by doing so you can identify any weaknesses and make adjustments to improve its performance in the future. When I first started using moving averages as part of my trading strategy, I knew that backtesting was the key to validating its effectiveness. That's why I turned to TraderEdge, a powerful platform that allows me to backtest my strategies with ease. And trust me, TraderEdge is not just any ordinary platform. It's specifically designed to make backtesting more efficient, with features like built-in profit and loss calendar and trade journal to track and analyze your performance. With TraderEdge, I was able to easily store and save all of my backtesting data, which was incredibly useful in refining my moving average strategy. So if you're serious about trading and want to give yourself the best chance of success in the long run, then backtesting is an essential step. I highly recommend trying out TraderEdge platform for yourself, and you can even sign up for a 7-day free trial using the link in my description box down below. If you enjoyed this video, don't stop here. Explore more trading strategies and techniques in my playlist. Watch this video next to discover new ways of improving your trading.